discuss a little bit about unrealized profit. How does it happen, or what is the rationale behind that? I said that parent purchased goods for $6, sold to subsidiary for $10. Half of these goods, very simple example, half of these goods are still in parents, in subsidiaries, closing inventory. Okay. Now this is one situation. Now before that, what you have, you've got your parent, you've got your subsidiary, and you have here sales. So and let me put sales here, and you've got here cost of sales, and you've got here gross profit. Now parent, what parent is doing, parent's own sales were, let's suppose 100, cost of sales was 60, and parent's profit was 40. This is what it is. Parent's gross profit is 40. And subsidiary sales are 70, and subsidiaries cost of sale is, I don't know, 35, and subsidiaries gross profit is 35. So let's suppose in the absence of this above transaction, let's suppose that this transaction does not exist. This transaction does not exist. And I ask you to make a group income statement. You have to calculate for the group. So logically, what you should be doing, group means actually consolidation means adding together. The first thing is that consolidation means adding together. You consolidate. And consolidation means elimination of intragroup transaction. If there is no intragroup transaction, I can say 170, and I can add, okay, so I will say that, this one plus this one, and this is here, and this is here. This is how it should look like in the absence of any kind of intragroup sales. If there is no intragroup sales, trust me, it will be as simple as it is. If there is no intragroup sales, this is exactly like I'm showing you. The problem comes with the intragroup sales. Problem comes with intragroup sales because this transaction comes in. They tell you that within this $100 which parent has sold, there is a $10 sale to subsidiary. And within the $60 of cost of sale, this $6 is added. So this $10 is added in 100, and this $6 is added in 60. And within this 40, the $4 profit is there. Now, P, the parent, is absolutely right. They purchased the goods, they sold the goods, they received the cash. They are not bothered if subsidiary is selling or not, because P is an individual company, S is an individual company. P does not have any information if S is selling or not. And even if S does not sell, P is not bothered about it. P is only talking about its own profit. P has sold the goods, probably have received the cash. Even if not received the cash, does not make a difference. P can recognize this profit. Okay, for P there is no problem, but for the group there is a problem, because the group considers that P and S, both of them, for the group, if you talk about, this is P and this is S. And these are individual companies in their own individual position. But within the group, they are same. They are under the same roof. The group does not consider the sale to happen. For the group, the sale has not taken place because the goods are still within the group. When you sell from P to S, the sale does not take place. It is just like you are taking from one warehouse to another within the same company. You may have 3 warehouses in your factory. So when you move goods from one warehouse to another warehouse, it is not considered as a sale. The goods, if S sell these goods outside, then it is okay. But as long as the goods are inside, the group cannot realize this profit. Okay, this profit may be realized by P, but for the group it is unrealized. Now, what happened that is sold 50%. Okay, 50% of the goods he has sold, and 50% they remain within the group. 50% are still under the same roof. And what is the profit on this 50%? That is called $2 unrealized, because total profit was 4. 50% of the goods are in the group, therefore 50% of the profit is unrealized. The profit on the unsold goods is called unrealized profit. Group cannot recognize it. Now, what is happening? If I made a total of this 75, okay, if I made a total of 75, it will not work now. Wait a minute, what did I do? Yeah, black. So this, now what I need to know, I know that there is a $4 of unrealized profit, $4 of total profit, out of which 50%, which is $2, is unrealized. So group profit, you know how much it should be? Group profit should be 73. Like 40 plus 35 makes 75, but for the group, the profit is 73 because $2 is still on the goods, and those goods are within the group. Those goods have not moved out of the group. So I should be making this profit not 75, but I should be calling it 73. Let me write it clearly. $73 I need to write this profit. Now, this is logically, mathematically, it should be 73. Now, how should we show the numbers? How should we show the numbers? Now, if you remember that you've got formula here for group sales. Group sales are parent sales 100 plus subsidiary sales 70 minus intragroup sales 10. The group should say my sales are 160. Always remember the revenue, the group revenue is the revenue which has been made to the outside parties. $10 was made to the inside parties. Just remove that. You cannot say that my profit is, my sales are 170. The revenue, the turnover for the group is the revenue to the external parties. Then you come to the cost of sales. Cost of sales formula I wrote above, it was parent cost of sale plus subsidiary cost of sale minus intragroup sale plus unrealized profit, this much. So I would say parent cost of sale, if you see this formula, parent cost of sale, let me decrease some space so that you can see it clearly. Parent cost of sale is 60. Plus subsidiary cost of sale is 35. Minus intragroup sales, not intragroup cost of sale. Please remember, not intragroup cost of sales. Just like you wrote 10 above, you write down 10 below. And you say plus unrealized profit, which is $2. This is mathematical expression of this number. When I put it here, and I put a bracket sign, I put it multiplied by -1. So now if you will subtract this thing, it will give you 73. Exactly 73, which you wanted. So if I do not add this $2, let's suppose I remove it. You know what will happen? It will remain like before. I need to decrease the profit. And how do I decrease profit? I increase the cost of sales. In order to decrease the profit, you increase cost of sales. So this cost of sale has been increased. So question 244, let's do it very quickly. It should be short and easy. It says, how will this affect group cost of sales in the consolidated statement of profit or loss? So group cost of sales. Let's see what do they say. Illusion company acquired 80% of Skeptic company on 1st July. In the post-acquisition period, Illusion sold goods to Skeptic at a price of 12 million. These goods had cost Illusion company 9 million. So 9 million he purchased, 10 he sold, 12 he sold. During the year to 31st March 2003, Skeptic had sold 10 million at cost to Skeptic. So 10 million worth of goods it had sold. Of these goods for 15. So how much he's selling for 15, I'm really not concerned. I only know that he purchased goods for 12 and 10 he has sold. So what is the closing inventory? The closing inventory is 2 million. The closing inventory is 2 million. So he does not ask us how much is unrealized profit. If he says how much is unrealized profit, you will calculate 2 million and whatever percentage. What he's asking you that how will this affect group cost of sales? In cost of sale, you know that there are two things which are going to create impact. What is the impact? Remember, group cost of sales is parent cost of sale plus subsidiary cost of sale minus intragroup sales. So intragroup sales, this is one impact, okay? Intragroup sales, what we do, intragroup sales, where did I go? Here. Intragroup sales, I will deduct. Remember, parent cost of sale plus subsidiary cost of sale minus intragroup sale. So the group cost of sale, if I say in group cost of sales, this will have a deduction of what? Of 12 million. So 12 million you will decrease. And then you say unrealized profit. Unrealized profit, you add parent cost of sale plus subsidiary cost of sale minus intragroup sale plus unrealized profit. So unrealized profit will be added. So how much is unrealized profit? We know that it is 2 million. And what is the markup or margin? You have to find out. You know the value of closing inventory is 2 million. That is clear. Value of closing inventory, because 12 million goods he purchased, out of 12, 10 he sold. So 2 million was there. But what was the ratio? What was the profit percentage? So it actually was, he purchased for 9 and he's selling for 12. So I can see that it is 3 to 4 ratio, okay? 3 to 4 ratio. If I put 9 here and I put 12 here, so it is giving me, 3 by 4. So 25% is their margin. 25% margin was there. Or you can do it otherwise, like if you pay attention that, 12 million into 25%, how much it makes? It will give you 3 million. 9 million was cost, 3 million was profit. It makes you 12 million. So it was a 25% margin. So I would say that, 2 million times 25%. So this is unrealized profit inside. And I would say, 2 million times 25%. It is 500,000. But the thing is, you must put it minus sign, because one is addition, one is deduction. So if this goes up, this goes down. Or you can say that either you put this as minus and this as plus, okay? So cost of sale will be 11.5 million reduction. A reduction of 11.5 million in cost of sale. Your answer should be answer choice C. A reduction of 11.5 million decrease, because this intragroup sale will decrease cost of sale, because formula was minus intragroup sales plus unrealized profit. So it is better to put signs properly. We should say that group cost of sale will decrease by 11.5 million. Then comes 245. What is the requirement? What will be the effect on group retained earning? Now they're asking us retained earning at the year end of 31st December 2007, when this intragroup transaction is cancelled. So if you cancel the intragroup transaction, what will happen to group retained earning? So let's see the transaction. On 1st July 2007, Spider Company acquired 60% of the equity share capital of Fly, and on that date made a 10 million loan to Fly Company at a rate of 8%. Oh, so that's intragroup loan. And on intragroup loan, there is interest which has been received or paid, and that intragroup interest should also be subtracted. So that intragroup interest loan you have to, just subtract, cancel it out. So it asks you what will be the effect on group retained earning. Now, that is a little bit interesting thing, because what will happen? Spider is parent and Fly is subsidiary, okay? I'm just taking more time. You can do it very quickly. It is less than a minute question, but I'm just taking time for explanation. So who is giving loan? He is giving and he is taking the loan. And here it is interest income for him, and here it is interest expense for him. How much is that? It is 10 million multiplied by 8%. And multiplied by 6 divided by 12, because it is for 6 months. It is 6 months, 1st July to 31st December. So in Spider's individual financial statement, there is a 400,000 of interest income. And this interest has been paid by the subsidiary. In Fly, there will be a 400,000 of interest expense. These two will cancel out each other, and you would say that there is no effect. Answer is no effect. There will be no effect on the group retained earning, because one has interest income, another has expense. They will cancel out each other. Then even when you eliminate, it will have no effect. So that was pretty simple. Then comes 246. 246, it says, okay, let's first read the requirement. What is the total comprehensive income attributable to the NCI, non-controlling interest, attributable to NCI at 30th June 2008? Okay. So total comprehensive income, what goes to NCI? Let's read it together. Vili Company acquired 80% of Toyota Company on 1st January 2008. At the date of acquisition, Toyota Company had a building which had a fair value of 22 million and a carrying amount of 20 million. So there is a $2 million, revaluation, a fair value adjustment. The remaining useful life of the building was 20 years. So 2 million is the fair value adjustment. You divide it with 20 years. Toyota Company's profit for the year is 1.6 million, which accrued evenly throughout the year. Vili Company measures non-controlling interest at fair value. At 30th June, it estimated that goodwill in Toyota Company was impaired by 500,000. Okay, so it's very simple. It was like we did a few questions like this before. All what you need to do is find out the adjusted profit and then make adjustments and make divisions. So what is the profit? It says that total profit is 1.6 million. We did this question very similar like this. We should say profit for the year. So profit for the year is 1.6 million. Okay, I'll write it down like 1600. But what is happening? You got it on 1st January and you are preparing on 30th June. So you talk about 6 months. So you call it here post-acquisition profit. Post-acquisition profit is 800,000. That's all, very simple. And now you have to subtract additional depreciation. Okay, so additional depreciation is like 20 million. 20 million divided, no, I'm sorry, 2 million. It is 2 million divided by 20 years, multiplied by 6 divided by 12, the 6 months thing. Just subtract the 6 months. It will decrease the retained earnings because additional depreciation. And then there is goodwill impairment. Here there is one thing interesting. Let me do the question and then I will explain you. Goodwill impairment. How much is the goodwill impairment? Goodwill is 500,000, right? 500,000, and all of that is impaired. So this is 800,000. Okay, let me put this as also minus, and this 500,000 also minus. So this is 800,000, this is 500,000, and you make a total. So your group subsidiaries adjusted profit, I would say subsidiary adjusted profit. Subsidiary adjusted profit is 250,000. And how much goes to the NCI? NCI is, I think, 20%. So 20% of that will go to NCI. So 250 times 0.2. This is your answer, $50,000. Pretty simple, not very difficult.